Good afternoon, fellow traders. Thanks for joining in to another webinar in the Blue Sky Forex webinar series. I do apologize for this small delay in initiating the webinar. It was due to technical setup. While the last few people connect, I would like to confirm whether you can properly hear me and see the presentation. Perfect. Thank you very much for the confirmation. So just to get the risk disclaimer out of the way as well, please bear with me for a few moments. Contents of this material are provided by a third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, our today's agenda is I will briefly introduce myself, whoever is new here. We'll talk about very quickly about the two market types you will come across when carrying out your daily trading activities. We'll take a look at how to size your account, essentially what capital or what monetary size you should be investing into trading. We'll talk about risk levels and of course at the end the very currency trading dangers as per standard, and of course you can ask your questions at the very end. So if you do have any questions in the middle of the webinar, then please write them down and then you can just shoot in the end and I will try to answer them as best as possible. If any of them remain unanswered, then please don't hesitate to send an email to webinars@hotforex.com. So I'm one of the senior traders here in Blue Sky Forex. We are an education, research, and trading group. We teach various strategies. We all have our different approaches. Some of us are technical, some of us are completely fundamental traders. We do also provide 24-hour trade support and analysis just to help retail FX traders to make better trading decisions and trade safer in overall. And Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So the two market types that you will come across when carrying out your daily trading activities is first price action, aka a trending market. It is more powerful, and the reason behind this is that the proper trend that you can properly benefit from should be fueled by significant news or some kind of significant economic event on the market that is making the price move enough for you to jump in on the train and benefit from it. You definitely have heard the saying, trend is your friend. It is definitely true. Proper long-lasting trends will yield really high profits. You just need to know and understand what is making that price move. If the move is significant enough or powerful enough for you to have enough time to properly benefit from it, and identifying or trading the price action or with the trend, it is a bit more difficult than trading on a mean reversion market. It's because that you will have to have some degree of fundamental understanding of the events and the news that can make the prices move. So you don't have to have some financial university degree in order to be a fundamental trader, you still have to understand um, what makes the market move. Okay, just straightforward. The other market type is the mean reversion, aka a ranging market. It is more common. It's easier to identify because the price is essentially bouncing between the nearest support and resistance levels, and it's really easily observable as well. The only thing you need to do is, on this occasion, to be able to draw your own support resistance levels, or you can also rely on the daily pivot points or the daily support resistance levels that are provided and determined by different providers. You can easily Google, daily pivot points or daily support resistance levels. You will find a lot of pages that provide this information. Usually they provide 3 levels of support and 3 levels of resistance. Some of them provide even more levels for you to draw onto your chart or just mark down later on. Excuse me. But no matter the market type you're trading in, you will still need to be able to manage your money and manage your risk accordingly. Otherwise, you will be ultimately gambling, even if you have a sound strategy. On the technical side, if you cannot manage your money or manage your risk, you will still most likely not be a profitable trader longer term. Okay. So, how to determine a best account size or a reasonable account size for retail traders? A few things to keep in mind. First thing is that if you invest too little, I know it might sound a bit sketchy, but if you invest too little, you're not giving yourself enough headroom for a bit of a drawdown. Okay, you will most likely not be profitable with all your trades in all your sessions. You might even have some months that your account balance is decreasing. It is experiencing some losses. It's completely fine. No strategy will work all the time. If you're investing too little, then you're really not giving yourself or your capital enough headroom for a little downtime. Okay. And just to give you an example, let's say you invested $1,000 and you experience a loss of $100 on one single trade. That means you have already lost 10% of your total account equity, right? However, if you invested $10,000 and you experience a loss of $100, then the loss would only be 1%. And already knowing about these percentages and how much you have lost, it affects you psychologically a lot. Okay, knowing that you lost 10% of your account balance on a one single trade makes you feel psychologically stressed. And being stressed while trading is a big no-no, right? So investing too little, it will cause you a lot of stress. So please try to refrain from even thinking about it. And how to then determine a reasonable amount to invest. We'll get to that in a bit. So, not really an investment advice of any kind, but just we are just approaching this information from a reasonable standpoint, right? Investing, perhaps if you are a starter, if you want to really seriously engage the markets, but you are just starting out and want to, get to learn the tools, get to understand the markets a bit, etc. Of course, starting with a demo account would make sense if you're still developing a strategy. But if you already passed that and if you want to take it to the next level and you want to start up a live account, obviously some kind of a live investment is required, right? Starting perhaps anywhere from $5,000 completely up to 30,000 is considered reasonable. Okay, anything below $5,000 is already taking it down a bit too much. Of course, again, this is not me providing you investment advice, just reasonable observation. Okay. Anything over 50,000 or even 30,000 may result in complete lack of your capital. You expect your account capital to be enough in size for you to play around a bit, right? And if you have this approach, then eventually you might end up gambling. You will take more undisciplined trades, and you're not most likely you will not be analyzing the price enough to make a successful trade, because you always know you have enough balance on your account to lose some trades. It doesn't matter, a few hundred here, a few hundred there. No, it's all fine, right? Because you have $50,000. But eventually, after some time, you know that these $100 losses, if they accumulate, they will result in $10,000 of loss of your account capital. And you only realize it when it actually has happened. So investing too much, unless you have a complete professional, trading background, is not really wise either. Okay, so keeping it between maybe $5,000 or $30,000 is considered reasonable. Okay. However, how to determine the exact amount? It depends completely on your NAV, aka net asset value. This is essentially everything you own, excluding debts owned. Okay. So all your the house, the car, etc. So maximum of 20% of your net asset value. And that should be the complete maximum you invest to trading. Okay. So which means that let's say you live somewhere nice where the house costs and the cars cost a little money. And let's say your net asset value is $100,000, right? Then the complete maximum that you should consider investing into trading would be $20,000. Okay. So something to keep in mind. Don't go over the 20% of the net asset value. That would be really unreasonable. Try to keep it between 5,000 and 30,000. If you invest $100 into trading, sure, but you are really gambling and you're not really serious, and most likely you will not be in it for the long-term profits, right? Maybe you just want to initiate a few trades, see if you win or lose, but that is considered gambling, and if you want to do that, fine. Who's going to stop you? But if you want to be a serious trader making some serious gains longer term, then you need to approach this reasonably. Okay, this is not a get rich quick scheme. Trading is a serious business. It requires a lot of attention, a lot of learning, and a lot of focus. Okay, so something for you to keep in mind. Right, so 5 things to take into account or to keep in mind when determining the actual risk levels in FX or anything related to risk when trading. The first of all is leverage. The second thing is risk reward ratio per trade or per trading session. I will explain a bit more later on. Then, of course, maximum percentage of exposure per trade. We'll talk about correlation risk and, of course, event risk. So, how to determine what leverage you should use? Okay. Just putting it really bluntly, what leverage is essentially how much funds are you borrowing from the broker to initiate a trade? Okay, if you have a little account balance, then you can use a high leverage to be able to make larger profits. But as it is a double-edged sword, it can also cause you larger losses. Okay, leverage is something that can be used by retail traders who don't have a lot to invest in their trading. If you don't have $100,000 to invest in trading to trade without leverage, then of course you most likely will end up using some degree of leverage, right? So just for an example, if you have a $100,000 and you invest that, and you will not use any leverage, then of course you're not trading on margin. You cannot receive a margin call. And if you open up $100,000 position, then any 1% move will result in $1,000 profit or loss, or just 1% of this $100,000. Just fairly simple and straightforward. If you use leverage, however, then that 1% will rise and your losses or gains will be larger based on that percentage and based on the leverage. So it is best not to use any leverage at all, because then you will be trading with your own money and you're fine. If you do need to use some leverage because you don't have too much to invest, then keeping the leverage as small as you can is optimal. Okay? Because if you use a leverage and the trade goes against you, you might hit a margin call, thus your position will be cancelled out or closed automatically by the broker, just to make sure that you're able to cover for the losses. Okay? And of course, this can result in premature trade closures, especially if the market is volatile. Then it's just really bad because you cannot carry out your proper trading plans as you intended. Okay, so use 1-to-1 or no leverage, or maybe 5-to-1. You can go ahead and use up to 50 if you have a really low account balance, but anything above that is relatively unreasonable. So I know that some brokers offer 1,000-to-1 leverage. That is quite extreme already. So, if possible, just keep it as low as you can. Okay. The next thing, risk-reward ratio, or reward-risk ratio, depends on how you put the numbers. It doesn't really matter. You can say it in either way. Regarding the below numbers you see on this slide, we're talking about the reward-risk ratio. Okay. So regarding the reward-risk ratio, it's really important to define that ratio before you enter the trading session. So what you can do, you can define the reward-risk ratio per trade for every single trade separately. And you can also consider risk-reward or reward-risk ratio per session. Okay. So if you set it per trade and that ratio is static for all the trades, meaning that all the trades will have the same reward-risk ratio, that automatically translates into reward-risk ratio of that certain session, right? If the reward-risk ratio varies between the trades, so let's say one pair you prefer having a lower reward-risk ratio than with some other pairs, then obviously you will consider them, pair by pair basis, and you can still have a global session reward risk ratio. Okay. What reward risk ratio means is that if you set it 1-to-1, it means that your take profit and your stop loss levels are the same distance away from your entry price from each other, right? So let's say your take profit is 30 pips away from your entry and your stop loss is also 30 pips away from your entry. Makes sense? So if you raise the reward risk ratio to 2-to-1, that means that your potential take profit or your potential gains are 2 times as high as your potential losses. So your take profit is 2 times the distance of your stop loss. Okay? It will make sense to use, if you are a starting trader, if you're a beginner, then use a reward risk ratio of 2-to-1. Okay? So your potential gains are twice as high as your potential losses. When you get better, if you consider yourself as an intermediate trader already, you already know the tools, you understand the market a bit, then you can raise it to 3-to-1. Okay? If you practice and get better and consider yourself an advanced or an expert trader already, then you can raise it up to 4-to-1 or 5-to-1. But I wouldn't really recommend to go any further than 5-to-1, because if you are setting these unrealistic reward risk ratios, then it is really difficult to reach your take profit levels. And before you reach those levels, most likely the price will reverse and hit your stop loss level instead. Okay? So when defining your reward risk ratios, please use optimal values. Don't set it too high and don't go anywhere below 1-to-1, because then your take profit or your potential losses are larger than your potential profits. Of course, this might translate you making more positive trades or profitable trades by the end of the day, but eventually you will realize that in order to be profitable, you have to make 2 profitable trades to cover up for 1 losing trade. Okay? And then your trade accuracy needs to be really high in order to be profitable longer term. So going below 1-to-1 isn't really advised, and going over 5-to-1 isn't really advised either. So keep it between 1-to-1 and 5-to-1, depending on your level of experience. All right. And regarding the stop loss as well, if you are a scalper, if you are a short-term, high-frequency trader, then fiddling around with your take profit and stop loss levels per trade isn't really advised, because then you are acting out of emotion. If you see the price going against you, you think that, okay, well, I should give it a bit more headroom to move to the negative side before it actually goes to my predicted direction. Then you will eventually end up making the small mistakes and losing a bit more money. Okay. So if you are a scalper, or if you're a generally short-term trader, when you initiate more than 5 trades per day, then do not fiddle around with the stop loss and take profit levels. If you are a longer-term trader, however, and if you're aiming for these larger pip gains, then managing your stop loss level continuously while the trade is ongoing does make sense. And it should be done, because at some point you want to lock in your gains. Okay? For that, you can use a trading stop, which is available in MetaTrader 4 as well. That trailing stop will automatically manage your stop loss level, and it will move your stop loss level closer to the current price if it is making new highs if you are on a long trade, and new lows if you are on a sell trade, if you're on a short trade. Okay. So trading using trailing stop will make sense here, or you can also manually adjust the stop loss as you see fit. Really often traders are moving the stop loss to the break even level. That's what I've read. I don't set it to the break even level myself. I am using the trailing stop because I see that doing it manually. I'm sorry, automatically by the program, and it takes the emotion out of the equation, right? So max percentage exposure, that means that um, what should be your trade size and what should be the maximum loss during one single trading session before you walk away. Okay. Right. So a rule that we live by here in our team is that no single trade should be able to cause a larger loss to your account than 1%. Okay. So no single trade setup should cause a loss greater than 1% to your account equity. If you follow that rule, then you will be able to stay in the industry, more time than if when you wouldn't have this rule in place. Okay, if you are initiating trades with lot sizes that are really not meant to be for like a high frequency trading, for example, and then you will be stopped out of the market quite quickly. Okay, try to keep it at 1% maximum for each and every trade, because then you will be able to continue to trade on the next session and the session after that. And in conjunction with that 1% rule, you should consider an additional rule that if you have already lost 5% of your total account balance on that single trading session, then you will simply shut down your tools and walk away, because in this case, you will be able to return on the next session and continue trading during different market types, okay? Different market conditions. Maybe during that single session, the market conditions were not really favoring your strategy. Then there's really no point to waste all of your money for that single trading session if the conditions were not right. When you're stopping yourself out, then you will be able to return at another time, and perhaps then the market conditions will favor your strategy, and you can actually earn back the lost money from the previous session and some profits on top of that. Okay? You can use the Kelly risk management formula that you see at the bottom of the slide in red. It includes the win rate and the profit factor. Now, if the equation results in higher than 5%, then you should still keep it below 5 or just at 5. Okay. So, two key things to take away regarding max percentage exposure is that no single trade should be able to cause more damage on your account capital than 1%. And if you lose 5% of your total account equity during a single trading session, then simply stop and return on another session when the market conditions may be right. Okay. The next thing to keep in mind, and this is really important, is that please try to refrain from trading correlated pairs simultaneously. Okay? If you trade highly correlated pairs simultaneously, and then you are just exposing yourself to double the risk, and especially if you're trading those in the same direction. I mean, in the opposite direction, but you're favoring one part of the currency in the same direction. Okay. And what I mean by this is, okay, Euro USD and the USD Japanese yen, they are somewhat inversely correlated. The better example here would be USD and Swiss franc and Euro USD, because they are really, really inversely correlated pairs. They are like mirror images from each other. You can just open it up on your live chart and see for yourself. Now, if you went long on USD franc and short on Euro USD, then you are essentially in the same trade but on a different pairs, right? So you're just making double the trade and you're exposing yourself to double the risk. As we always here suggest to trade as safely as possible, because then you have more time to improve yourself, improve your strategy, and learn the markets and everything that comes with it. Then just trade as safe as possible, and you will remain in the game for longer term. Okay. So don't trade correlated pairs simultaneously. If you want to definitely trade both of those pairs, you can do that, but don't do it on the same time, right? Okay, and another thing is that if you are trading low liquidity pairs, then you are paying higher spreads. Thus, your ROI in the longer term will be lower. So, especially if you are scalping, then spreads will hit your potential gains really hard. So you should try to stick to trading the majors. The majors usually have the lowest spreads, and then if you can check the spread schedule for different brokers, you can witness the majors having the lowest spread. And this is usually what brokers advertise as well. They provide you with a list of the majors, and they say what the spreads are for those pairs, right? To find out what pairs are uh, correlated with each other, you can just use Google and type in correlation heat map. There are a lot of different providers, a lot of different charts that show you this information. There are different types of charts. Some of them are easier to read, some of them are more perhaps uncomfortable or difficult to read. It's really up to you which one suits you the best. Just check out different versions, which is most easiest to read for you. Okay, and just realize and study which pairs are heavily correlated, either positively or negatively. It doesn't matter; they're still correlated. So you can just keep that on the side of your trading platform as well, just to make sure that you are not initiating correlated trades, or better yet, just stick to having only one trade open at a time, because then you are also trading as safe as possible, right? Because maybe there was some kind of event that you didn't really pay attention to, or it was not really marked on the news schedule for the day. Maybe some politicians said something really awkward on Twitter, for example, or out of emotion that caused a lot of havoc on the markets, made the prices move. And if you had several trades open, then obviously you have heightened risk to being stopped out for many trades rather than one, if that makes sense, right? And as for event risk, we're talking about different economic events and news releases. For beginner traders, we highly recommend just to stay out of the markets when there are some significant news or events released at that time. Perhaps half an hour prior to the news and 15 minutes after the news, after the market has settled a bit. After 15 minutes usually, this is the time it takes for the market to make sense of the numbers, and then it will uh, usually be determined quite often whether the Bulls won this match or the Bears won this match, and the trend will form, and then you can obviously trade with the trend. But of course, there's a lot of different things to consider before actually initiating a trade after a news event, and that does require a lot of practice and patience and focus. So let's talk about adding to positions when in loss. This is aka a martingaling. Okay, martingaling is extremely risky. It's not recommended, especially for new traders, because it might sound like a really good idea at first, and theoretically it is. However, you would need millions of dollars in order to remain trading and martingaling on the same asset in the same direction for an extensive amount of time. The market can remain trending in one direction for a very, very long time, and longer than you can remain solvent with your account capital. Okay. Of course, if you already had millions of dollars, then most likely you might find better investing opportunities. Okay. Anyway, martingale again is just doubling up your position on the same asset in the same direction, hoping to earn back the losses generated by the previous trade and earning some profits on top of that. So you can martingale forever, essentially, as long as you have enough balance. So this is the reason why a lot of people go over line with martingaling, and they eventually end up losing a big portion of their account capital, or just losing the complete account capital. And a good alternative to this is dollar cost averaging. And essentially, this is gently building up a position on the same asset and in the same direction, but getting a better average price during the process. Okay, I will explain a bit more in a bit more detail. I will give you an example. Let's say that if your standard trade size is one lot for every trade you initiate. Okay, so instead of initiating one trade with a lot size of 1, we start off initiating one trade with a lot size of 0.3. Okay, now let's pretend that the market moved against you, let's say for 15-20 pips. Then you initiate a second trade on the same asset in the same direction, again with a lot size of 0.3. If the market still moves against you, initiate a third trade with a lot size of 0.4 on the same asset in the same direction. So now you have 3 trades open. All of them are on the same asset in the same direction, but essentially you're getting a better average price, better average entry price. Okay? So in the scenario when eventually the price reverses and goes in your desired direction, you would have earned larger gains because the third trade uh, will have the most or the highest pip gain. Okay, and you got a better average price. And if the price still continues going against you, then you will have lost less money because the last trade you initiated would have had the lowest um, pip loss, right? Makes sense? Okay. So you are gently building up your position across several trades on the same asset in the same direction, but you are not doubling up your position size. You're just still initiating what you usually would have invested, like lot size of 1 on this example, but you're just spreading out that lot size between multiple trades. Okay. Now, a few things to keep in mind that this dollar cost averaging will not work out well if your initial trade accuracy is really high, let's say above 65%. This way, dollar cost averaging will erode into your longer term profit gains, because in this situation, the very first trade you initiate with a lot size of 0.3 will already be profitable trade, and you will have won less money than if when you would have initiated the trade with a lot size of 1 just from start off. Okay. If your initial trade accuracy is not high, maybe around 55 or 50% only, then dollar cost averaging can actually increase your longer term profit gains if done right. So definitely something to consider. Please analyze your trade accuracy and then decide whether you want to try out dollar cost averaging or not. Okay. So last but not least, let's talk about currency trading dangers. First and foremost, do not trust bots or any automatic system that is initiating trades on behalf of you. Most of these systems, they are designed to generate losses on your account. So please be extremely careful. If you want to try out a trading bot or that kind of type of a system, then please do so on a demo account at first. If you see this system being profitable for longer term, 4, 5, 6 months, and without any larger drawdowns, then sure, why not? Consider setting it up on a live account, but please use low lot sizes because you still need to be trading as safe as possible. Okay. The next thing is that it is sad but true, only 5% of the retail FX traders make money in FX longer term. And this is due to our own brains, human psychology, that is causing a lot of people just being naive, jumping into the game, and eventually realizing that they have been bullied by the advertisements, or they are just ignorant enough not to invest any time in learning how to actually trade. I'm quite sure a lot of you have seen advertisements by different brokers on different websites saying that you can get rich quick with the push of a button, right? Essentially, it is true, but you all know it's not so simple as it sounds, right? There is a lot of things you have to consider when you're trading. Of course, you can simply push a button and win some money. That is correct. Yes, we can all do that. But I would consider that as gambling, okay? Because you're not really analyzing the price, you're not really making any effort to make an appropriate trade decision, okay? So definitely, spend some time to analyze what you're doing. Keep a trading journal, analyze your trading after each trading session, because this is the only way you can properly find out what are your trading habits and make some adjustments later on to your strategy and to your habits in order to become a better trader. Okay. Another thing to mention is that emptying or blowing up one or two trading accounts is not essentially or necessarily a bad thing. Most, if not all, professional traders have been there. They have emptied one or two accounts, but what differentiates them from the other 95% is that they had enough wit to learn and to correct their mistakes and to analyze themselves and find out what they did wrong, and had enough courage to keep on going and actually improving. Okay? So if you blow up one or two accounts, it means that it's time to change something, that you need to learn, you need to improve, you need to change part of your strategy. Don't change it completely. Don't be jumping from strategy to another strategy, because in this case you will be searching forever, because there is no such thing as a perfect strategy that works all the time. This is often referred to as the Holy Grail. Okay? A strategy that is profitable all the time in all market conditions. Now, this thing does not exist. When I started trading, I read about this Holy Grail, and everybody's like looking for this. And in forums, there were topics, I have found the Holy Grail, etc. But was nothing more than simply a strategy based on some technical conditions that actually worked for a few months. But after people started using that or replicating those conditions, it failed another 3 months before it started turning profits again. But those 3 months were so bad that you could easily empty your account. So Holy Grail doesn't exist. If it does, we don't have access to it. Only the big players do. So stop searching for it. In order to be successful, you need to develop your own strategy, tailor it to your own needs, tailor it to your own trading habits. You have to customize it completely. You can use different strategies from different people online as a template, but ultimately you still have to adjust it to your own trading skills and habits, right? And this is the way, and of course, by analyzing yourself and your mistakes, this is the way you can become successful and profitable longer term. One thing to mention, that if you do empty one or two accounts, that does not necessarily guarantee that you will become a successful trader longer term. No, it's not guaranteed. You can still fail. You can empty third and fourth and fifth account before you give up. Okay, I don't want to um, draw some pink flower pictures or glasses and you can put them in front of your eyes not to actually realize the truth. But this is how it is, right? It doesn't guarantee you success. Last but not least, only 5% of the signal services and signal rooms are legitimate. Same goes for the automated trading systems, right? If you want to try out any kind of signal room or signal service, then before investing your hard-earned money in them, invest some time to do a background check. Ask for a performance record and an audit trail. Ask for the experience from another traders if possible. Ask if they have been profitable longer term using that signal service or signal room without any large drawdowns. If so, then sure, go ahead and test it out yourself. But again, use a demo account and see if that system or a strategy or a signal service can generate good enough signals for you to be profitable longer term without large drawdown. If yes, only then consider setting it up live, but then again use low lot sizes. Really, really important. Okay. So this is it for this webinar today. I will open up the webinar for questions. Let me just open up the questions section here so I can get them and answer as we go. Okay, I see no questions at the moment here, so I will make a last call for questions. Okay, well, the lack of questions means one thing, that the material and the explanations were clear enough to get the information through. I'm happy about that. So from my side, thanks again for attending this webinar today. It was my pleasure to be the host, and I hope to see you next time. So meanwhile, take care and trade safe. Have a good day.